Okay, Chapter 12 goes into a topic that you know a little bit about because we talked about it in the first part of the class, and that is stockholders' equity. You know stockholders' equity as being part of the accounting equation, but now, and you also you did a statement of retained earnings, which is part of stockholders' equity. So now we're going to kind of go into that in more depth and explain how those two relate to each other and how you account for those. Okay. All corporations have common stock. If they only have one type of stock, it's common. Let's talk about the advantages of a corporation first as a form of business. Easy transfer of ownership. Because corporations sell shares of the company to millions and millions of people, it's very easy for one shareholder to sell their share of the corporation to another stockholder of the corporation or shareholder. It's same word used interchangeably. What you get, you don't get a piece of the building and a piece of the truck, all of that. You get a certificate saying you own a certain percent of the company. The more shares you have, the bigger your ownership. Once a company sells stock in the market, the company has gotten their money, well, from the initial public offering. Stockholders are then left to their own devices to figure out if they need to sell their stock or if they want to buy more stock. And that, of course, gets done through broker-dealers, not through the company. They're not in the business of buying and selling stock. They're only in the business of issuing stock to bring in money for operating their company or starting their company. We did not talk about sole proprietor and partnerships. The weakness in those organizations is if one person leaves, then the whole company has to shut down and start over again. All the books have to be closed out and you have to start anew. There's no way to trade it off to someone else. Limited liabilities. This issue is not as big as it used to be. Corporations provide limited liability because as a shareholder, the general public cannot sue you. They can only sue the corporation, but they cannot come after you as an individual. It used to be in partnerships and sole proprietors that you were 100% liable, and you could be sued personally as well as your company. And so that was a real disadvantage. Now they have come up with limited liability companies that gives them the protection of a corporation without having to set up a corporation. But before that time, they didn't have that. Continuous existence, of course, with so many shareholders and everybody trading stock, the corporation can go on and on and on. It would never end until it goes out of business for some reason. It's an easy way for companies to get a lot of money. And let's see, I'm going to skip those others, not that important to me. Double taxation is one of the disadvantages of corporations. Companies have tried for years to get Congress to change this. Corporations pay tax on all the income they earn before they pay out dividends. Dividends are not deducted. And then the dividends get paid to you and me as shareholders, and we have to pay tax on those as income. So the money's getting taxed at the corporate level, and it's also getting taxed by the shareholders. So you have double taxation going on there. Although in recent years, tax laws have been changed to reduce the amount of tax that you have to pay on dividends. You can read about some of these technicalities of setting up a corporation. I don't consider them that important for this class because it's not a law class. Organization costs, they give you an example here of it costing $10,000, $15,000 to set up a corporation. That would be an incredibly complex corporation at this day and time. If you want to set up a corporation for yourself, you can go on the internet and do it without paying any fees, paying anybody to help you. You just have to pay the fees to the State Corporation Commission, and you have to go to fees to the IRS to get a tax ID. But it is really, really easy these days. The state of Virginia has made it very easy for you to set up a corporation. Okay. There's an organization chart here depicting how a corporation is supposed to operate. Secretary, treasurer, VPs are supposed to report to the president. who is supposed to report to the board of directors, who is supposed to report to the stockholders, meaning the stockholders are in control of the board, board's in control of management, management's in control of its lower level. What I have found in my business experience through 25 years is that stockholders have very, very little control over the corporation. Unless you're a huge stockholder, the piddly amount of shares you have probably isn't going to make a difference. The way it works, if there's something that the company wants that requires shareholder authorization, the company management will tell the board what they want to do. For the most part, the board is going to do it. They're not going to give them a lot of fuss over it. And the board of directors is going to tell the stockholders to vote yes for it, and most of the stockholders are going to vote yes for it. So these two levels don't necessarily exercise their ownership rights. They just act like sheep for the most part. Bigger shareholders, like when you've got big pension plans and mutual funds, they're much more vocal. Those stockholders are much more vocal. Boards of directors have become more responsible since 2000 because of a law that was passed after a bunch of companies failed back in 2000, Enron, WorldCom. And now there are laws on the books that say if these directors don't do their job, if they don't pay attention to what's going on, if they don't understand there's fraud going on in their company, or they're not careful to check on that, they can now go to jail, as well as these people. So boards of directors have become more involved and more responsible for the way the company is run since 2000. That law is called Sarbanes-Oxley, the Sarbanes-Oxley Act, and I had you all do some research on it. Okay. Now, companies can issue stock with what they call a par value, or without a par value, or with no par and a stated value. All of this is pretty much obsolete these days. I want you to just read through here on the reasons for all this confusion. But I think back early, particularly after the stock market crash of 29, the government, in trying to make sure that people didn't lose everything they had in the world again, made companies give their stock a par value. And that amount of money was supposed to be set aside in case of a failure. At least the stockholders would get that amount of money back. Anything that they sold the stock for over that amount would go in a separate account. Since then, most of the laws, those laws have been rescinded. There's still a couple of states who have legal capital requirements, but not that many. So we still have this antiquated thing that we have to deal with in doing stock entries, and you just have to do it. All right, no par stock means they didn't state any par, and you can have that now. At least some states allow that. They can do no par with a stated value, which is just like par stock, and then you can have stock with a stated par. Other terms you need to know: market value, that's the current value of a company stock. That's what one buyer and one seller come to agree on as to where they would exchange the stock. That's the market value. Book value is taking the assets on the books, subtracting out the liabilities, get net assets, divide by the number of shares outstanding, and that's the value per share. Not a very useful piece of information anymore, because so much stuff is carried on the books at cost and not at current market value that it's a pretty irrelevant number. Liquidation value only happens if a company is in default and going out of business. Okay, the board of directors, when a company is first organized, authorizes how many shares of stock the company can sell. They normally authorize way more than the company is going to issue to begin with, just so they won't have to go back to shareholders and ask again. Stock that's issued is what has been sold to the public. Capital stock outstanding is stock that has been sold to the public, less any stock that the company has bought and brought back into their treasury. Sometimes companies will buy back treasury stock. We get this in the next chapter. They will go out and buy their own stock, maybe to keep to fend off a hostile takeover bid. Maybe it's to give options to their employees for performance bonuses. Maybe it's to make their earnings per share look better, which we'll get into in the next chapter. There are a variety of reasons. Don't worry about those now. I'll go into those later. But you have authorized stock, you have issued stock, and you have outstanding stock. And the difference in issued and outstanding is what the company has bought back and put in what they call the treasury. Okay, all companies have common stock. Some companies also have preferred stock. And it's called preferred because it has some preferences over common stock. For the one thing, it has a fixed dividend rate, which we'll get into more in the next chapter. In the event of liquidation, preferred stockholders get paid before any common stockholders get paid. Preferred stockholders receive their dividends before common dividends can be paid. And there are lots of different features that can be attached to preferred stock to make it more appealing. You can have a cumulative preferred stock, and that is you have to pay preferred shareholders all their dividends in the past that you've missed before you can ever pay common shareholders their dividends. So if you haven't paid a dividend in 5 years, year 6 you pay a dividend, all of that has to go to the preferred stockholders up to the point of catching them up through year 6. If there's any left over, it goes to common stockholders. Some preferred stocks are non-cumulative, meaning if they lose a dividend 1 year, it's gone. It's not going to be accumulated. Some preferred stocks are convertible into common stock. And if it becomes beneficial, that's a feature that preferred stockholders like, because if the common stock does extremely well and they have this agreement that they can convert into common stock, they may be able to make a good amount of money on that. Preferred stock is callable. That is, a company can at any time, and this will be written into the documents about the preferred stock, it will be in the prospectus. The stock can call that preferred stock, and there's a set price at which they have told these shareholders, we can at any time in the future, we can come to you and say, we want that stock back, and we agree, we pay you this price, and that price is firm, it doesn't change. So that is a feature of preferred stock that you do not have on callable stock. Now, I've talked about these things that are coming up next. I just went through them in 1, 2, 3, 4 order. You can now read about those and read some examples. I think that would be beneficial for you. Now, balance sheet presentation of stocks. Stockholders' equity has, at this point, for you, 2 components. Paid in capital. That's money that comes in from selling shares of stock to the public. That's why it's called paid in. And then there's retained earnings. That's those earnings that you've been accumulating in your company and not paying out as dividends. So there's 2 pieces of stockholders' equity. What comes in from selling stock, what is there from retaining earnings of your company and not paying it out in dividends. Okay, and then they give you examples of how you handle these various stocks. If it's a par stock, in this case it's 10,000 shares authorized, $20 par. They sell, was 10,000 shares they're issuing at $22 a share. So first of all, figure up the cash. The company sold 10,000 shares at $22. Cash came in at $220,000. You have to divide this into 2 separate entries. Common stock account gets the par amount, 10,000 times 20. That's the old reserve. And the $2 per share over that goes into paid in capital in excess of par on common. Okay, and here is how it looks on the balance sheet in the stockholders' equity section. So this is for a par stock. Now we look at no par stock, but it has a stated value. So it's no par, but they assign a stated value of 20. They sell it for 22. The entry is exactly the same. Okay, same thing. No par stock, everything goes into the common stock account. So you put in cash at 220. This should be 220. It's an error right here. You put in just the amount of the 10,000 shares at $22. You don't have any paid-in capital in excess of par because you have no par. Stock can be given for land. It's not always for cash. Companies can buy land with stock. If they're cash strapped, they may just give shares of stock for the value of the land. They may pay organization costs to their lawyers by giving them shares of stock. Okay, so now let's look at the expanded stockholders' equity. And remember, these always have to be in this particular order. In the preferred, in the paid-in capital section, first thing you have is preferred stock par. That's there. Common stock par. That's there. And you get a total. Paid-in capital in excess of par or stated value. First is from preferred, then from common. And you put a total over there. So now your total paid-in capital is $525,000. Your retained earnings is $200,000. You need to be very familiar with this because you're going to have this on the test for sure. Of course, you've got your book to look at, but remember it's preferred first, then common, and that's just the par amount. And then paid-in capital in excess of par goes next, preferred first, then common, and then total paid-in capital, then retained earnings. Not going to worry about book value. I think it's worthless. Okay, that's it for Chapter 12. Chapter 13 is lengthy. It has a lot more topics in it. I might even break it into two sections because I don't like to do lectures that are much over 15 or 20 minutes because I know you fall asleep on me. So I deliberately try to keep these things short. Of course, all the problem solutions have been done for these three chapters, and they're showing all the illustrations they need to. There was just a problem with me sharing the book, which I finally figured out today. So I will stop there and very soon get to chapter 14 or 11, 12, 13.